Hey everyone, I want to do a very quick video on Beachbody and walk you through a couple different scenarios. It's a lot to cover, so I'm just going to move quick. The first thing I want to point out is these Bollinger Bands right here. And what I'm noticing here is a pattern. The stock is using the Bollinger Bands as support and resistance to form a trading range. So the first thing I notice is as it gets down here on the support line, it doesn't break below. Instead, it goes right back up to its resistance. And then what does it do? It goes right back down, and then right back up, and then right back down, and then right back up, and then right back down, and then right back up. Eventually, the stock is going to break out of this trading range, and it's either going to go higher or lower. And since you're looking at the chart, I guess you can figure out which way it goes. But in the meantime, when you see something like this is what you or I as a trader like to call a pattern. You can trade within a trading range. So think of it more like this: in, out, in, out, in, out, in, out, in, uh-oh. Now you need to start cutting your losses because it's going to be pushing lower. So that's the first thing I wanted to go over, using Bollinger Bands as support and resistance. People always say, like, do you use all the indicators all at once, all the time? Sometimes yes, sometimes no. In this case, the answer is no. I'm strictly using the Bollinger Bands as a support and resistance to trade within. The second thing I want to talk about is this breakout to the downside as that happens. If you're in the stock right here, if you get in somewhere around here and it breaks, you need to have a plan to cut your losses, because otherwise you could end up with a pretty significant loss. So let's just say you're out. So let's just say you cut losses, or maybe you didn't even get in on this trade and now you're waiting to see what happens as it's broken to the downside. When it breaks to the downside, we like to step away. Same as when it breaks to the upside. You don't want to chase. You don't want to try to catch a falling knife. You just want to sit back and wait. And what we're waiting for is it to consolidate. So the first thing I notice is that we have this huge red candlestick right here. Actually, let me get rid of these Bollinger Bands to have the screen look a little smoother. We have this big candlestick breakout to the downside. Now we are trading on the negative side of this 20-day moving average, right? We have resistance, support, and this 20-day moving average. It's more like a psychological indicator. When it crosses below moving averages, for example, like it does here, this is 200-day, this green is the 50-day, this blue is the 20-day. When it crosses below, it's a bearish indicator. When it crosses below all three, that's a bad sign. So I like to sit back and wait. Now, even though it does enter oversold territory, the first thing I notice is that we've had a huge candlestick down. Usually when there's a big drop, it's followed by more selling. The second thing I notice is that we are on the negative side of this 20-day moving average, which means that I don't want to trade this stock. I'm trying to time the bottom, catch a falling knife. Nope, I'm going to wait. What I'm waiting for is for the stock to become even more oversold, because the more oversold something is, the more likely it is that it will have a rebound. It's not a guarantee. It's just an indicator. And sure enough, the very next day, we enter into very oversold territory, at which point, as a trader, I'm going to open a position in the stock. Now, it is a little bit more expensive at $6 a share and some change. So 1,000 shares would cost you 6,000-ish bucks. That's a lot. It would probably cost you around 6,400 if you were getting in right here, which is where I'd be getting in. Now, the next thing I want to talk about is setting a goal. I talk about this frequently because the markets are so volatile lately. I'm in and out of my trades a lot quicker, which usually means I'm taking profits of around $200 to $300 on a trade, unless every indicator is saying that the stock is going to keep running higher. In other words, I'm not being greedy. I'm taking my money and I'm using it to pay down my health insurance, which is $308 a month, my condo fees, which is over $400 a month. You get the idea. So on a stock like this, I'm setting a goal, and you can use Fibonacci retracements to help you kind of pinpoint potential price targets. So what we want to do, because in this scenario we're doing it in the day, this is at the time going to be the low. So instead of the low being down here, it's going to be here. And what we do is we right click on the top, which is 802, add drawing, and go to these Fibonacci retracements, and then we're going to drop it right here. I don't know why. Does anyone else have this problem where it doesn't well, there it goes. Now I can get an idea of where this stock might go and potential price targets. So take out your calculator, and let's say that we are in at 640. which is right around, actually, you know what, it looks like it's closer to 657. So let's just make it easy and say 660 is our entrance price. And where could we potentially sell this stock? Well, we could sell it at 690. We could sell it at 711. So I start doing some math here. 690 minus 660, that's 30-cent gain. If I have 1,000 shares, that's 300 bucks. Okay, so I now start to think, if this stock can get up to 690, I'm probably going to be out unless we have some indicator or something that changes. And we do, because we have this right here, this breakout to the upside, this green candlestick. It's a breakout to the upside, and we have crossed over this resistance line, which means it could go here. So the next thing I do as I'm plotting out all my goals is, okay, well, if it goes to 711 and I'm in at 660, it's a 51-cent gain. All right, so I'm getting ideas here. I'm going to make anywhere from $3 to $5-ish $100 on this trade, depending on where it goes. So I have options. Yes, it's crossed over. Yes, it's a breakout to the upside, but I'm up 300 bucks. Do I want to roll the dice and be greedy? Do I want to hold out a little bit more? Maybe squeeze out another $100 or $200 in profit? That is up to you. I would honestly probably have gotten out, taken my 300 bucks in a day, day and a half, and been happy with it. If you want to hold out for a little bit more, well, we've got a breakout, so you could, in theory, hold out to 711, 728. You got choices. But I, in this scenario, am out. Now, it does continue to run up a little bit higher, and then it reverses. Look, you can see the volume isn't very strong, which is another indication to me that it might not rally too much more, unless something obviously happens. So again, look what happens. Cross over the 50-day, cross over the 20-day, and we start to trade in negative territory. So again, I sit back. Sorry, that's my chair. It cracks every time I lean back. We are in negative territory with a couple of breakouts to the downside. So I'm waiting, I'm watching, and what I'm watching for is, are we going to get oversold again? Because if we are, that's a buying opportunity. You can see we don't. But what do we have instead is a narrowing of the Bollinger Bands. When they narrow together, it could be an indicator that the stock could break out, upside or downside, depending on where the stock is. The second thing I noticed is that we start to consolidate, right? This is good. Consolidation is a sign that at least the selling is over for now. It's not a guarantee that it's going to go up or down, but the consolidation is good. It means that at least temporarily the heavy selling pressure, in this case to the downside, is done. Great. So we're trading sideways here. That's indicator number one that I want to start paying attention. Indicator number two is that we cross over this 20-day moving average again. Indicator number three is this breakout to the upside. That's good. Indicator number four is another breakout to the upside. And indicator number five, are my numbers correct here? We have a crossover of the, which one is this? The 50-day? Yeah, it's the 50-day moving average. And by the way, you can click on any line, right-click, and it'll show you 200. So we have a lot of positive signs here. Double breakouts, crossovers, narrowing of the bands, everything looks good. I'm going to open a position here right now. So let's say I get in on the stock at around $6. Let's just say $6.50. $6.50. Again, these are my potential price targets. Now what I'm noticing is something is happening. We've got very strong volume to the upside here. We're crossing over every resistance line. We cross over the 20-day. We cross over the 50-day. We cross over all these Fibonacci's. We cross over the 200-day moving average. Higher and higher and higher. Lots and lots of volume. This is all very positive. So even though I have my goal of, say, $200 to $400, I'm amending my goal now. I'm changing it because I'm saying, look at all the positive signs we have here. This thing could continue to run. So the next thing I start to look for is this right here, the relative strength index. I'm looking for the stock to enter overbought territory because overbought territory indicates that there could be a sell-off. People are going to start taking profits. I want to lock in my gains and get out. I'm likely going to do that somewhere around here, right? Because I'm not super greedy. I just want to get my money and get out of my trade. I'm going to lock in my gains. So let's say I get out at around $7.30. And I was in at, what did we say, like $6.50? Let's just say $6.50 for easy math. That is an 80-cent gain. And now if I'm on 1,000 shares, that's pretty significant. If you're not on 1,000 shares, though, it's more, it depends. This is, again, a personal thing. I like to trade with dollar goals because I'm trading with large amounts of money, so I can say, well, I'm going to make 800 bucks or whatever. When you're trading with a smaller amount of money, it's more important that you're focusing on the percentage gain and not the dollar gain. Because if the stock goes up 80 cents and I have 1,000 shares, I make 800 bucks. That's significant to me. I've covered my health insurance and my condo fees. Done. If you are trading with a smaller amount, so you're buying 100 shares and it goes up 80 cents, you've made $80. And so that doesn't seem so significant to you, right? But if we look at a percentage calculator and we say, okay, you sold at 730 and you were in at, say, 650, that is an 11.5% gain. That's significant. Now, I have the same percentage gain as you, just a different dollar profit because I'm trading with more or you're trading with more, whatever. So that's that. When you're trading with smaller amounts of money, it's more important you focus on the percentage gain, because you might look at it and go, 80 bucks, no, I want to make a lot more. But you're up 12%. In order to make big money, you would need the stock to have a massive run. And the indicator right now is that it's overbought, which indicates a sell-off. So you don't look at the dollar, you look at the percentage. Wow, I'm up 12% on my money. That's significant, especially for a quick trade, which happens to be in a day. A lot of time when we buy based on something like this, we're not expecting that it's going to have this rocket, boom, straight to the upside. We're thinking it's a swing trade. I'm going to be in maybe days, maybe weeks, potentially even a month or longer. So when you get a gain like this very quickly, smart money is to lock in some, if not all, of your gains. Next thing I want to talk about is it starts to sell off again, right? So again, you notice crosses the 200-day to the downside, crosses the 20-day, and we're in negative territory here. If you look back over time, big candlestick to the downside, big selling to the downside, big selling to the downside. This seems like a pattern. So now what I want to do, because this is all behind us, is I want to do more Fibonacci retracements. And you're going to see why this line is here in a minute. Because even though I'm not in this stock at the moment, I would potentially like to be. So we go from high all the way down to low. We drop our Fibonacci retracements. And this is what I'm keeping an eye on now. My hope, see, I don't want to catch a falling knife here. It's indicating to me that we have much more downside potential. Now I can jump in here and it could reverse course and head right back up, but that would be dumb luck. And I don't trade on dumb luck. I want to trade on as many, I want as many indicators as possible to back up my trade. So I'm not going to get it here. I'm going to wait. And if that means I miss my opportunity, oh well, there might be an opportunity on the upside to get in and ride the momentum higher, like what we saw here. Even though the indicators on the downside weren't there, the indicators on the upside were. So that's why you want to have a couple different options at your disposal as a trader. Now, I don't want to set an alert for this because I might miss my opportunity, right? If I set an alert, I right-click and I say create alert withdrawing, tell me when it crosses below this Fibonacci retracement. What if it doesn't cross below? My alert doesn't go off, I'm not paying attention to the stock, I miss my chance. So what I like to do is create my own little line here, which you can do. I'll get rid of it so I can show you. Hello, why isn't it going away? Oh, it's being weird. It should go away, but it's not. I go to add drawing, and I go to this support level or price level, and you can drop this line anywhere you want. So I've dropped it here. Let's just drop it a little higher so I can walk you through another example. Create alert withdrawing, and now I can say when it crosses below, alert me, and you can see there's my alert. When it crosses below this line, that's when I start paying attention. Now I'm waiting and I'm watching. Are we going to get to 610? Are we going to enter oversold? Is it going to be a little oversold, or is it going to be a lot oversold? Then I make my decision. One last thing I want to talk about, because I'm realizing I forgot, is this big jump happened in the after hours. The market had already been closed. So the important thing to pay attention to here is when you go to set your sell order to lock in your gains. Let me do it like this because I like this one better. You want to hit, I have to move it up. You want to hit, oh geez, I got to move it even higher. You want to hit good till canceled, which gives you up to 6 months, I believe. You want to fact check that. your order will stay open. So you can say, hey, you know what? I'm not looking at the stock market this week. I'm very busy. If the stock crosses over $7.20, sell it. So you go in, you change this 720, and then you set it till good till canceled. Now, good till canceled is locking you in just as day during the market hours, which is 9:30 to 4. So pre-market or after hours, your order won't go through. So in this example here, look what happens. It's all after hours. The markets are already closed. And look what happens when the market opens. It drops. So you're screwed if you have just set a day or a good till canceled order. What you want is extended. Extended means pre-market or after hours. If your stock hits your target price at any point, pre-market or after hours, it'll trigger. And same with good till canceled, but that's only for the day. Good till canceled plus extended covers you for however long the good till canceled part lasts. So that's how I would trade the stock. I'm going to now keep an eye on this price. If it gets down to 610, I might open a position. If it doesn't, maybe I'll catch it on the upside. So I hope you thought this video was helpful. If you did, hit the bell, hit the thing, hit all the stuff. Thanks for watching. Have a good day.